Hi, everyone. Let's have a good week. How you doing, Hugo and Kevin? I hope everyone had a good weekend. So this week, not sure what the big feature is going to be. Arena, how are you? So I came in looking to buy dollar weakness and came in and there's dollar strength. So I'm taking a shot here that there will be one more dip in the dollar to take us down towards 92.40 in the coming days and risking the double top breakout. So when we look at euro, where are the stops, right? I'd say here's a big stop right here at 92.70, and then you have this stop up here. So these are the two, targets for stop hunters or people to gun for liquidity. My bet is that we take this one out first before we take this one out. This is going to be a breakout above here. That's me. Or some people would say it's 94, it still could be 94 up here, right? Here's 93.80. But I'm starting to think it's, here and here up around 93.60. We've had a few tests. So thinking we might get one more shot down. And with that happening, perhaps everything that's green could turn, everything that's red could turn green one more time. Metals really taking it on the chin with a strong dollar. And as talked about for weeks, silver leading the way to gold being down here. I do think we are going to eventually get this breakdown under 1910 in the gold. We'll see if they could generate one more rally in the gold, but I'm looking for, a lot lower levels. So with this sell-off, we're getting a little dip in yields. A lot of people still thought that we were going to get new lows in yields. I'm not sure that's going to happen. And what a tricky close in VIX. VIX gave it up on Friday and then gaps up today. So looks okay, but my comment was going to be coming in that maybe there was going to be a rally because VIX didn't perform during the sell-off on Friday. And when we get to the S&Ps here, I have confluence down here around 3,200, where I have this vertical line, horizontal line, excuse me, and a speed line coming in here. So 3,200 was always kind of a big number. For me, you could see how it acted here. We had a little false breakout, then back underneath it, and then held it. And this is really where the acceleration took place in August from this 3,200 level. We're not that far away. So we'll see what happens. 3,200 gives way. I think you're looking at 29.77 or so for the next important one. Although there's a moving average up here around 31.14. Oil, weaker. But holding the confluence of these two moving averages. Oil too. So, my hope, or, what I'm looking for in the week is all this weakness. We generate one more rally to get short into, and it's really I'm going to key it off of this dollar index, one more dip. And I guess I could say the descending triangle in euro contained this advance. Everyone see this, it poked through it a little bit. We got through it a little bit last night. But the look in euro almost says like there is a possibility that we could hold it and drive one more time, maybe get a false breakout, take out some stops here. What are the key stops in this market? Obviously, it was this false breakdown is an important stop, also an important breakdown. And, you have buy stops here and buy stops here. Maybe we have to clean those out before we get a bigger break in euro. So we'll see. I could be dead wrong on the dollar and we could just blast and break out. But, you know, everything's a probe. If I lose 40 points, I lose 40 points. You know what I mean, guys? So, you know, it's never fun to do it, but no pain, no gain. Right? So we'll see what happens there. And, you know, we have this promo going. It'd be any of you guys acting on it, on the price discounts right here, 2 for 1, 4 for the price of 6, 7 for the price of 12. And also don't forget, Friday we start our summit. Seats are going. I don't know how much more room we have. I think we're starting to run low to be able to watch it live. So, you know, get signed up so you don't have to wait for the recording. EJ, hiya Jess, how are you, buddy? You know, EJ, I thought we could get to 22. That's kind of what this measured from here, Jess. So, starting to diverge a little bit here, but it's under 30. Let me look at the 15, get real money. Yeah, I don't see a bottom yet. And I don't have the guppy up. Hey, Jess, ping me on Skype later. Okay, buddy? Haven't heard from you in a while. All right, so that's what I have to say on a Monday. I'm still getting the cobwebs out of my eyes right now. S&P did break support, but, you know, there's support underneath it too, Rahul, you know. And to me, 3,200 has always been important. Blake had a great support level, 33 that it took out. So, you know, there are support levels given way. I just don't think this is going to be a collapse, but it could be a correction that takes us, you know, let's look at the weekly here. Here's a moving average at 30.75. I think Ben Maldonado was talking about a battleground in the 3,000 range. And this is where, you know, I think it could go is back to this old breakout, which is about 29.70. But I don't know if I would just sell it in the hole today, Rahul. If you got short last week, great. Don't forget about taking partials, especially if we do approach at confluence at 3,200, which has a confluence of, you know, this and the major support line. Okay. How are you today, Blake? How's your microphone?
I'm good. I'm good. Can you hear me?
Yeah, it's very clear.
Okay. You know, I realized when I pull out my for this particular device, when I pull it out of the USB port and I put it back in, I actually have to go back into Zoom and adjust the volume.
Wow.
So
yeah, Zoom's
touchy. Yeah, so I did it, and it seems like it's working better. So yeah, happy Monday.
Loud and clear, boss.
I'm sorry?
Loud and clear.
Yeah. I was surprised actually to see the markets where they were this morning. I mean, you know, too. Yeah. I mean, when I got up, I'm like, wow, and I'm happy about it. Obviously, I'm positioned for this particular movement for a breakdown in risk. And you know, if you look at like our active patterns in play, so is myself and Grega, who had put in our patterns in play, you can see that we were very well prepared for what's happening. And so it's good. But like last night, you know, the dollar Canadian, I'll just give you an example here. The dollar Canadian was trading at 131.70. And, you know, when we were trading down here last night, I was like, this is before I went to bed. And it's like, man, and you think about it, I'm long, a lot of dollar Canadian. So, I'm sitting there waiting for this big inverted head and shoulder pattern to play out. And, we're trading at the lows. It looks like we're breaking down a little bit last night. And it's like, man, and I'm not going to sit there and start adding just before I go to bed. You know what I mean, Dale?
Yeah.
I mean, that it's like I'm going to sleep. I'm not going to just double my position size, even though I felt, I feel that we're going to eventually go to the 200-day moving average here, but I'm not going to just double.
I did the same thing with Kiwi. I said, well, I don't, I'll wait till tomorrow. I said,
yeah, exactly. Right. You don't want to overexpose yourself going, just before you go to bed. And, like you look at the Kiwi, we got the,
well, sometimes.
Well, it depends what kind of. Yeah, I mean,
on special occasions.
Yeah, special occasion. Maybe as long as your wife doesn't have a headache, it's all right.
That's what I mean. Special occasions.
Special occasions. Oh, my head hurts. Stelios gets that excuse all the time, and so does Steve. So me, it never happens to me.
I'm usually the one with the headache. I'm usually the one with the headache.
Oh, really?
Yeah,
wow,
that never role happens. Reversal.
That never happens. Jeez, right. It must be something real special, Dale.
Just
all right. So anyway, that was the whole reason why I got up this morning and I was like, wow, and obviously I had to go. If you use ForexAnalytix, I had to go and make sure a lot of the charts were updated, even though we have some updates that happen, like Amanda updates throughout the European hours. Usually when I come in, I start, updating some of the charts to give you guys a better idea of where we're sitting at with some of these, some of these pairs. And so, when we do that and you see these, you see these big moves, it's like, it's kind of busy in the morning because and now we're stuck in a, what do you do? Because, I look at the S&P. We're obviously breaking through this support. This is previous resistance, current support. And as I have been explaining to you guys for the last week, a breakthrough 3,300 here is a trap door to the 200-day moving average, which is 3,100. So this right here is a 6%, trap door for the market or more. But when it starts happening, you have to ask yourself, do I do this? Do I get short now, or do I wait for the, end of the day, or see how the day develops? And, I just heard Dale, you just say this, which is, very important. Selling in the hole right now is hard to do, like getting short right now, after this big move overnight. I don't know if it really makes sense. Now, does that mean that we're not going lower? No, we may be going lower, but what could happen here, and what I think is probably more realistic, and I may be wrong, obviously, but you see a bounce back to 3,300, then you see a sell-off. I could be completely wrong here, and you might get I'm just drawing this, but I'm gonna erase all this here in a second. You might get a situation where we just get a sell-off that looks like that. We may not even get a rally to 3,300. Back to 3,300, or maybe we, put in but what could also happen is we put in a false breakdown, and next thing you know, we're trading at 3,350.
I think it's dollar related, Blake. If we had the dollar come off, we would get a pop in S&Ps.
Yeah, I would agree with that. I think the dollar is probably influencing a lot of this move.
Yeah.
But then again, is it the dollar, or is it the yen, or is it gold? There's a lot of different things that are weighing in on this for sure. By the way, I'm squirming around in my seat because this weekend I took my.
You have hemorrhoids?
Yeah, I got hemorrhoids.
That's usually why I squirm around.
That's exactly what happened. No, I went to the park this weekend. Just took my dog for a walk yesterday morning, actually, just over to our neighborhood park. And I was standing there, and I was wearing flip-flops because, it's still hot here. For those of you that don't know where I live in the desert, and it's still warm here. So now when you think of desert, you don't think of grass, but, obviously we got a lot of, grass, and it's lush. We're in the city. but it's still hot. Anyway, I was standing there and the dog's running around and, you know, picking up poop and all this fun dog ownership stuff. And I look down and my foot is getting eaten by a bunch of ants. And so now my feet, my left foot like itches like crazy from the ant bites. So it was fun. Do you guys have ants in Greece, Stelios?
Ants, yeah, we do, but not the killer variety that you guys have.
We don't have killer variety. I mean, we have
Fire ants.
We have.
You're in the desert. Everything wants to kill you there.
Yes, yeah. The desert is very harsh weather-wise, and you know, things that live out here usually can fend for themselves. That's for sure. But no, there was just like some sugar ants that were gnawing at my feet. It's itchy though, you know, my foot's like completely itchy. Anyway, all right. So I'm like squirming around in my seat with my hemorrhoids and itchy feet. Joking. Okay. All right, guys. Well, hey, you know what we should do is we should actually analyze all these currency pairs. But Stelios, did you do you know if that live Twitter or no, it'll go out in a little bit, right?
It's going out right now, actually.
Okay, yeah. So, hey, we need to talk about, for those of you that are not aware, we have a big pricing special for ForexAnalytix. Dale just mentioned it's 12 months for the price of 7, 6 months for the price of 4, and 2 months for the price of 1. So it's buy 1 month, get 1 month free. We haven't done this pricing special since the beginning of COVID lockdown. So it's been 5-6 months. Usually we run a special sooner than that, but things have been really busy. You know, we haven't had the opportunity. So I know a lot of people have been waiting for this particular pricing schedule to come out. And so guys, if you're waiting to be a ForexAnalytix subscriber, this is the time to do it. Now we've talked about that, but also if you guys have not entered the giveaway for ForexAnalytix, there is a tweet. So if you find ForexAnalytix on Twitter, here, let me pull up ForexAnalytix. Just give me a second.
I just tweeted it.
Okay, thank you. So if you find ForexAnalytix on Twitter, so here, I'm gonna go ahead and just, so you guys have this, I'll put it in the chat box. So you know who we are, if you don't follow us already. So there's the Twitter. All you have to do to enter is see this giveaway offer. Just respond to the giveaway offer. So respond to the offer and say, I'd like to enter the giveaway offer. Like Man of Two here, Simon has done this as well. And Simon is a ForexAnalytix subscriber, by the way. And you can be a subscriber and still be part of the giveaway because we're giving away gear. Okay. You know, we're going to give you a t-shirt, coffee mug, mouse pad,
a Porsche.
We're out of hats. Sorry. Hats are completely gone. And that's because Stelios has them all. Joking. He does wear a lot of hats, but no, but you also get 3 months of, if you are one of the 3 winners, you'll get 3 free months of ForexAnalytix. And we're adding that on top of your subscription if you're already a subscriber. So you could be a subscriber already and still be entered in this. And it does not require any purchase. So all you have to do is retweet this tweet, and then also respond to ForexAnalytix. Okay, so make sure you guys do that. And don't forget just to sign up. If you've been waiting to sign up, just sign up, because even if you win, we'll add 3 months to your subscription. So remember, we're doing this random at the end of the month, I think, right? If I'm not mistaken. Anyway.
Good question. I'm not sure.
I forget what the day is that we're doing that. We'll confirm that, but I believe it'll be at the end of the month. So you probably got like another 10 days to do it. So let's talk about the markets, and let's get into that, because I do want to talk about where we're at. So if you're dealing with the euro has slipped back down towards 117.50. As you guys know, and I don't have to continue to tell you this, I am expecting a little move down in the euro. I think a lot of people are expecting the euro to really slump, towards the 115 level. I think we'd get really lucky if we got towards 115. When you look at this possible move, like a target of this head and shoulder pattern, it would take you down to 115. But I think that it all really depends on how aggressive we see a move lower in risk or something of that nature. Like if the S&P goes from, where we're currently at like 3275 and we go to 2800, yeah, the euro is probably going to go to 115, maybe even a little lower. But if we only get a correction to like 3100 in the S&P, I would be surprised if the euro reached for 115. It might actually only make it to 116. But you're going to see dollar strength minus the yen. That means forget the yen pairs. But you'll see the dollar strengthen against most major currencies if we continue to see this breakdown in equities. It's just the dollar's a risk off proxy right now. And it has been for a while, but it's even more so in this environment where, rates are basically at zero everywhere. The dollar is going to firm up a little bit when we see some risk off. So you have to anticipate it. So again, it's, for me to sit here and say, oh, the euro is going to 115 or it's going to 116 or it's going to go to 113. I can't really make that decision not knowing where equities are going to go and how far equities are going to go, because it's really more or less dependent on that. I don't think it's because, the Fed's changing course at all. No, we know the Fed's going to be dovish forever. So anyway, so what we should be looking for today is how we react on any move down to 117 and 117.50. So 117 is major support. 117.50 dips have held. So, just keep that in mind. I have a hard time shorting the euro down at these levels. I really do. I'm not saying that I want to be long, but I'm not comfortable being short. There's other ways I'm playing the dollar right now, and obviously I'm long the dollar Canadian. I'm short dollar yen. I'm trading the dollar in different ways, but not currently the euro. The euro yen is a different story, which we'll talk about. Well, I talk about that during the members only daily roundup. So I don't think I'll have time to discuss it here. But anyway, any move back up to 119 is going to find sellers. Are we going to find 117? Are we going to get to 119 today? We'd be really lucky. I think 118 and a quarter is probably more realistic today. Okay, let's go over to the cable. And we are in a range environment right now. So the cable, wow, what a big rejection here. We talked about this resistance zone last week. And as you can see on Thursday, Friday, we just kept knocking our head up against the resistance zone. I mean, that's obviously very important now. So, what should you be doing here? I don't know. I think support is going to be at 128 or, 127.60. Okay. Hold on. Sorry, this is just is this an article that was just pushed? I'm going to save that for later. Okay, what was I saying? Oh, the cable. All right, so resistance now on the cable on any rally should be back at 130, obviously. So I do think we're in a range. Actually, we're borderline turning bearish in the cable, just so you guys know. And, we're range bound right now, but, I still think that the cable's the weak link at this moment. Okay. Aussie. So the Aussie, we're in this upward sloping channel. We're approaching trendline support here, which has been previous channel support. That'll come in right at 72.20. And then below that is 71.50. So I'll have to write down both those levels. 71.50, 72.20. This one is probably more important. That's why I'm going to put an asterisk here. And we are in a range. Resistance being the 618 up there, which will be, once again, 73.40. $73.40. Kiwi. So the Kiwi dollar, you know, Dale, ultimate failure Dale on not shorting more Kiwis up there last night. I'm just kidding.
Yeah, I know. I'm aggravated.
But hey, but you know, one thing that we should note, and this is from actually Friday, is we did have a false breakout on the highs. And then now we're at risk of a double top. So this is one thing that you got to keep in mind with the Kiwi now. And I'm not saying it's something that's going to happen right now, but if we break 66 cents, that actually targets to 64 cents now. Now that a lot has to happen between now and then, but that's, you look at the dollar Canadian and you start thinking, okay, if we get an inverted head and shoulder pattern and we break the dollar Canadian, we go from 132.50 to 135, which, you know, that's what, again, if you use ForexAnalytix, that's what I've been targeting since 909. So that's been what, today's the 21st. Okay. Obviously, if you guys have been sitting here listening every day, you kind of know where I was going with this. Anyway, if we're going to 135 in the dollar Canadian, where's that, you know, where's that take the Kiwi? Is that so off base where the Kiwi could drop from, you know, 67 cents currently to 64 cents? I don't think so. So especially if when we start clearing all this support. So you can see this nice double top is developing. Support for today, because obviously we're not going to do that right now. Support for today is going to be 66.75. And let me just double check those numbers really quick. That's a 618 retracement, just so you guys know. So it should be pretty good support today. So what did I just write? 66.45? Is that what it is? 66.75. Shoot, what's happening? What just beeped? Euro's cracking that. Okay. 66.75. It's a 618. We are still in a range, guys. So any rally back up towards 67.50 should be resistance. Okay. Dollar CAD. So I just kind of went through the dollar Canadian, but we'll do it again. All right. Now, well, I didn't really actually go through it. I just talked about it. So now any dip down to 132 should find buyers. So you have to imagine this is the inverted head and shoulder pattern that's developing. Today, I would hope we get something that looks like that. Okay. Which means that, you know, dips down to 132. Well, hopefully, you know, if we can get down there, I just don't know if we're going to get down there. Resistance right now is 132.60, just right here, right? Then after 132.60 is 133, which if you don't know why 133 is important, it is the spike low from right here. Oh, it looks like, do we have data? We have data coming out today, Stelios?
Very minor, no, not really.
Okay, I just heard Squawk talking about it. That's why I wanted to just.
We had some Canadian data really, but nothing major. We have Lagarde and Powell speaking later.
Yes, yes, yes. This is going to be very significant because that's the inverted head and shoulder pattern neckline. We are range, but we are threatening to turn bullish here. So just you guys know that it may be range right now, but that doesn't mean it's going to stay that way. Dollar Swiss, same crap, different day, right? 90 and a half, 92. So I don't need to go into great detail there. If you guys are here every day, you know where we're at, you know why we're there. This is actually still bearish. We're still bearish while we're below 92.50. So remember, this is a long-term dollar Swiss broken trend line, but you know, while we're below 92 and while we're below 92.50, you got to stay on the short side. And remember, if we get some risk off, the Swiss franc could actually strengthen. It could act very similar to the yen. So let's do the yen here, because the yen does not act like a normal dollar pair, nor does the Swiss franc either, especially during times of stress. So, you know, the dollar yen, we broke through the support here at 104.20. Now, the next stop would be you can see it right here, right? Okay. 127% extension takes us to 103.40. So we should have resistance right now at 104.40. Now, why did I say 104.40 and not 104.20, which is the support? It's because it's this trend line. See this trend line right here? That resistance comes in at, well, actually it'll be, by the time we get back up there, 104, yeah, 104.40, yeah, roughly. Okay. All right, you guys see that? All right. Yep. And then really, in order, if we break through this relative strength down here, that's probably going to be our cue that we're going towards 103.50. So, I mean, it's divergent right now, relative strength, but that we're just correcting a little bit. We could very easily turn bearish here. So, all right, we did, whoops, dollar yen, dollar index, dollar peso. Okay, dollar max. We are right at previous support, current resistance. Trend line resistance will come in at 21.68. We were bearish, but I think now any dip down to 21 is going to offer support. Well, I'll come back to that. That's 29.69. We went from bearish, what was bearish on Friday, to range, and we will turn bullish if we break this channel resistance here, which comes in at 21 whatever, 21.70, 21.69. Support should be 21.19 now, so not 21. Let's go 21. We'll just write 21.20 just to average that out. This is key. So I'm going to put a couple asterisks there. It will turn bullish if we break through that. Okay. All right. Dollar index. So dollar index above 94, as you guys know, is where it turns bullish, right? Because this is like all this resistance right through here. It all comes in at 94. So 94. It's resistance. Let's see. Support for the dollar index is at 93, whatever it is, 93, it now dips down to 93.05. Should be supported. Oh, FX trader, you're bearish the euro. Welcome to the party. Great. All right, I'm going to start buying euros here today. All right, US dollar, Norwegian krona. As you can see, we've now broken. This is the invert. Wow. This is a big inverted head and shoulder pattern here. Yeah, this is now at risk of, you know, jumping all the way to 10. The crude oil market and the weakness of crude. So that's something to keep in mind. All right, so now we should find support on dips down to 918. If you don't know why 918, it's right here. That's why. Right there. 918. This is now bullish. This is the first pair to really go bullish, right? I mean, whoa. Dollar max, freaking flying. Okay. What were you going to say, Dale?
Yeah, it's like leading the way, and Canada threatening.
Yep. Yeah. Yep. It sure is. Let's figure out where some extensions are. We're the 127% extension right now. 161% extension takes us to 934. So I'll have to write that. Okay. Remember, Goldman's still bullish the gold. So you got to think, where does Goldman have their stops? Well, they have their stops at 1905. So where's gold? Here it is. Okay. So gold just dropped $10 actually, just as I've been yammering away. When we started, we were trading at 1930. We've now broken that trend line. So now gold, this is a risk here. You guys know that if we break below 1905, which basically, I mean, I should probably just round it out to 1900. This is huge. Okay. We are range right now, but we are threatening to go bearish. And just remember, 1920, which we are below, or we're at currently, is the breakout, last known major breakout point. So that was the last all-time high back from I said 1912. 2000, was it 2012, 2013? What year was that? 2017?
2011 was a high.
2011. Thank you. 2011. So
I think it was 1912 or something like that.
Yeah, let's see. Let's go back to the monthly chart. Okay, so 2011, we're there right now, which was 1911, 20. 1920, 25. I think it was 20, but
yeah.
Anyway, here's, let's see, the high was 1921. So we're currently trading there right now. So obviously this is big support. We've dipped below, but not on closing basis. We just kind of dip. That's why a close below 1900 is huge. Okay. Today, a resistance for gold will be at 1960 if you do get any type of rally, just to think about it. 1960. Okay, S&P. So now any move back up to 3,300, and we are now turning bearish in the S&P. While we're below 3,300, we have to be. So support. Okay, let's figure out where these support levels are. The 88% retracement comes in at 3250, 3245. So we should write this. 3,200, 3245. And all right, there you go. Your bias chart's done, finito, finished. You guys should have a pretty good indication on what's going on. Now, Steve should be here momentarily, but before Steve... Oh, Steve, hey, how's it going? Hold on, let me finish this up.
Yeah, mate.
All right, guys. So remember, we have the ForexAnalytix, if you guys are late to tuning in, because we have people that come and then they go and then more people come, and this is kind of how it works. This is our giveaway offer. But I mean, this is our offer, current offer, but we're also doing a giveaway. 3 of you lucky winners that we'll do a drawing, random drawing at the end of the month. You're going to get a free 3-month subscription plus ForexAnalytix merchandise, mouse pad, probably the most comfortable t-shirts in the world. I'm not exaggerating when I say that. I wear my ForexAnalytix t-shirts every day, and I have 3 of them that I wear, and I think I wear them 5 days a week, which that means I'm constantly washing them. They are the most comfortable t-shirts ever on the face of the planet. Anyway, you get a t-shirt, mouse pad, and a coffee mug, and all this free stuff. Now, all you have to do is retweet this tweet. So you have to retweet it, right? I'm going to retweet it. So you retweet it, and then you have to mention or talk to the tweet. You have to
reply.
Thank you. Hey, remember, it's 5 in the morning here, and I've been up since 3. So just, so there.
I love those T-shirts. Mine are a little frayed.
I know.
After 3 years.
I know. Mine too. I mean, I'm telling you, Coach. I have 3 of them that I wear.
Yeah.
And I wear them 5 days a week. I wash them like all the time. They're ratty. They're so comfortable, and I love them. I mean, they're probably the most durable, most comfortable shirts I've ever bought in my life. Anyway,
hint, mine are.
I
gotta say them. I have to say them for the clients.
That's.
I know. I can't even. I have a box full of them, and I can't even, take new ones.
I was wearing one in the gym once, and the Greek guy came and asked me if I'm a client.
Oh, really? That's funny. That's hilarious.
Yeah.
Did you tell him you were?
Yeah.
Or did you brag about being a big shot?
Owner. Hey,
I just told him I'm part of the team.
Okay, right. There you go. Hey, guys, remember, do you make the big announcement today, Steve? Or is it too early?
We can make the announcement. The new hero section is going to be up shortly.
We have tweeted it already, so we can announce it. Yes.
Oh, we did. All right. All right, guys. So let's talk about it. First of all, we have this. The Trader Summit starts on Friday. I'm pretty excited. I get to interview Danielle DiMartino, which is cool. So she's I get to interview her. But you can see this lineup of speakers. That's Chai Girl, Chicago. So Chicago. So it'd be Shy Girl, right? Chicago. That's, and then obviously a lot of other great folks. Wait, who threw me on the speaker? I'm not a speaker.
Oh, you are.
No.
Yes, you are.
What?
Yeah.
He's kidding. Don't worry. We just like you, so we put you there.
No, I mean,
I'm half kidding. I'm half serious. Don't forget.
No, when am I doing a presentation?
You're not doing a presentation exactly.
Thank God, you guys can't spring that on me. So, what am I speaking?
You're opening the event.
Oh, okay, got it. I'm gonna open the event. So, so I get to be the what do they call that?
The ringmaster.
The ringmaster of the circus. Yeah. Okay. So anyway, we have this great event. If you guys have not, registered, make sure you do so. I know we say that, but you're not going to get a seat if you want to listen live. Now, here's why you're going to want to listen live. This panel, you can see the people that are on it right now: Peter Schiff, Pompolano, Yusko, Lacal. We're bringing in one more. Who are we bringing in?
Mark Dow.
Mark Dow. So if you guys know now, the reason why this is going to be so awesome is because Mark Dow, he worked for the IMF. He's been on CNBC a bunch of times. I actually interviewed him years ago on the Morning Edge. He's probably one of the smarter guys that you're going to find in like financial Twitter. But him and Peter Schiff, I would say they are on the opposite end of the spectrum, and they're both extremely witty and sharp, and to hear them debate about their points of view is going to be epic. So you guys cannot miss this event. It's going to be epic. All right. So anyway, guys, that's it.
Okay, thank you, Blake.
I'm done.
That's going to be really exciting for sure.
It's going to be cool.
It will.
I don't have to sell it any more than that. You guys, it's free. I mean, I don't know what I have to sell here. So, all right, guys, take care. All right,
thank you, Blake. Hey, everybody. Let's have a great week ahead.
We will. We also have the event.
Yes, absolutely. Interesting start to the week. Risk off. We've been talking about this over the past days. And we have been saying that the markets are a little bit complacent. They're not really pricing in a lot of the potentially bad things that could happen. So we have now a little bit of a triple whammy where obviously the number one, I think, thing is COVID making its reappearance. So there's talk about another lockdown in the UK. There's even talk about partial lockdowns here in Greece. And I'm sure we're not the only countries. And numbers are going up. Obviously, there's a lot more testing done, so that's going to bring numbers up anyway. But still, this is something that I've said before. I don't think it's going away very easily, and the medium-term effects, unfortunately, are going to be a little bit stronger or harsher than people think. So that's one thing that the markets are slowly realizing, that it's
Still,
coming. Yeah.
I personally have a theory. I don't know if you agree or not with it. As usually, we get another COVID headline as the explanation of, why we have risk off, which personally I'm not buying, because, we've never had really something that guaranteed that there's going to be an immediate resolution. So I think COVID, like the US-China deal, is more or less used because reporters have a very easy job just by, assigning blame or benefit to whatever comes out. I personally think that it's more likely that this might be the result of the market expecting, what should I say, more
From the
unrest.
Fed.
No, more unrest.
Fiscal.
More unrest due to the
election,
Scottish situation.
Ruth Bader Ginsburg,
that she died, then now she needs to be replaced, and I think perhaps it's expectations that unrest is going to increase more, plus the fact that with the polarization due to that, I think that the chances to actually get a deal having to do with some fiscal package, I think they substantially get reduced.
Yeah, are you talking about the U.S., Steve?
Yes.
Okay, and it's reduced because now the focus is on
exactly
replacing the Supreme Court. Ginsburg.
Exactly.
So
exactly.
No one's even going to think about the relief package,
Exactly. So that means that at the best case scenario, the relief package moves back in time, and depending on the election result, might be even several months away.
Yep, that's for sure a good point. There's also other things that are happening. Like I said before, triple whammy. The other two, one, you have banks really selling off today because, I don't remember what report it was, but really there's something like, quite a few trillion of dollars of transactions over the past 10 years or so are thought to have been money laundering. Surprise, surprise to everybody. And banks are getting smashed a little bit today. And also you have, the equities rally over the past months was driven by tech in a big way. And, you have even companies that are not 100% tech, like Tesla and Nikola. And well, you heard what happened with Nikola, right?
You did see that, right?
The chairman, the founder, resigning in the middle of an SEC investigation. That certainly doesn't inspire confidence in the company or the sector. So I think.
What about the guys that were pushing the truck?
So
in all honesty, I've said that before. There's going to be many books written about this period at some point in the future.
Yes. And you have companies like that and Tesla as well, trading at ridiculous multiples. But hey, it's a tech company, and we're investing in the future, not just the cars.
Pets.com, bro. Pets.com.
yeah, exactly. Pets.com. So anyway, I think there's a lot of little things. The COVID is the main one, I think, but there's also a lot of other things, like we've mentioned, which are pushing risk off, and I think that we still have a good chance of seeing a proper leg lower. And we were talking about metals before, and how this all-time high in gold is basically, we're there now. I think if that gets broken, it's not going to get broken for $50. It's going to go 17 to 1800, somewhere there. So, and that's what I'm waiting to get long again. And I've said this so many times: silver 21 to 22, I'm going to get long again. So
I think you'll see it.
We are in the precipice of a breakdown here, which triggers the second scenario. We had, since the beginning, two scenarios. One is that we break this triangle to the upside and continue to a new high. Two, that we break to the downside, we make a lower low. But as you said, Stelio, I think that's going to be it. My target is between 1820 and 1750. I think anywhere between these these two levels, gold should find support and continue to the upside.
Yeah, and for, just before you continue, I just want to say, I mentioned Nikola and Tesla. I've never shorted them because shorting them is a very difficult proposition. I think they're way too expensive, but I've never shorted them. So people who listen to me here but don't actually listen to the words I'm saying, I can't help you. But I've never actually shorted that. But I do think it's overvalued. Anyway,
Stelio, if I'm not mistaken, for so many years that we're friends, I might be mistaken, but I never remember you shorting a stock in any case.
Nope, I don't like shorting stocks. No.
So that's an invalid comment because
anyway,
you're a person that just buys value. That's it.
Yeah. Anyway, let's move on. Yeah.
Okay. So what else? Anything else from the news front?
No, we have Lagarde and Powell speaking. I don't know actually in what context it is, but we're going to get something, may get something actually from them. So worth keeping an eye on them, but nothing else overnight or this morning.
Okay, perfect. So, finally we have some activity in the markets, which is a great thing. So let's jump on the charts. Since we
Can you see the questions, Steve?
I can only see the questions from past 40, which is when I logged in. So let me cover some things that I would say anyhow, and then please give me, more of the questions. So I would anyhow start from gold and silver because I know Blake. I mean, I have a lot to say about FX, but I'm 99.9% sure that Blake did a wonderful job covering all that. Now, having to do with metals, as we said, 1920 key level for gold, also 1900. I think below that there is a pocket of air. As I said, 1750 to 1820 is an area I'm interested in, and I'm actually going to start scaling in if we get to that. Silver, same type of deal. I'm hoping for lower levels because I remain very bullish. So I'm hoping to be able to buy at lower levels. What does lower levels mean? 25.50, 23, 21. I don't think we can see lower than that. I mean, it's highly unlikely. I just gave some areas of interest, and of course, we have to judge based on the structure, on the way we're moving to the downside. So, we will be able to to talk more about what seems like a logical target and whatnot once we actually do break down, because it's still not a certain thing, right? From a risk reward perspective, gold is currently testing an area of support. It would make sense even if you wanted to buy it here. Now, there were people asking about natural gas at the end of the webinar on Friday, and they didn't have time to cover that. So listen, I had said many times that I would be more than willing to buy natural gas again if it actually found support above 205. So that candlestick that we got on Thursday, that monstrous candlestick, sliced through that area of support, which means that I'm not even looking to buy it anymore. I mean, if it's stabilized in this descending channel trendline support or on top of 205 and we saw some clear loss of momentum, I would definitely be buying it again. But I'm not willing to give back my profits just because 205 was an interesting level. 205 was a very interesting level, but not if the market decides to slice through it like it's not even there. Now, we stopped on Friday right at the 200 daily moving average, and the reason I'm mentioning this is because we are retesting it as we speak. So there's that support you can talk about, and we're exactly on top of it. So from a risk reward perspective, you can just buy it here with a rather tight stop loss. But personally, the fact that we reacted from the 200 DMA on Friday, but we seem to be plunging once again, does not look like a good sign. It would look like a good sign if today we were actually seeing continuation to the upside, but this is not what's happening. So I will remain sidelined. I made almost 20% on that move higher, and really I find no reason why I should jump in the market and give it back if the market is not behaving as I wanted to do so. Now, crude oil got rejected from the 50 DMA. working on an evening star formation here, retraced quite a big part of the previous move lower. Now, admittedly, the fact that we're selling off, strongly, but crude oil is rather close to the highs. It's not exactly what I expected, but from a technical perspective, speaking purely, I think there is a decent chance that we can see one more move lower, one lower low, one lower low before we continue higher. So ideally, something like that is what I would want to see, and I think it can still play out. We can even see a much bigger acceleration. In any case, my target always remained 29, and that's where I would feel that there is value in buying. So needless to say, I'm not considering buying crude oil unless I see at least this support zone being tested. Now, does it want to run higher and me having no position? I'm absolutely okay with that. I don't want to force myself to have a position if I don't like the terms that the market is offering me. So, as simple as that. Now, clearly, I wrote this in the weekend analysis, both for USD CAD and USD NOK. Actually, for USD CAD and USD NOK, I had to write the exact same text, more or less, and you'll see why. In both cases, I wrote quite confident about it that they are consolidating the recent gains in preparation of producing most probably another leg higher. And that's exactly what we're seeing here. Here's USD NOK and here's USD CAD. I'm pretty sure that Blake already covered this. So, I think we should see one more leg higher in these pairs. Okay. I'm still holding my short USD NOK position because it's very, very deep in the money. And I do think that this is a corrective bounce and, that this is a long-term position. I was fully expecting that there's going to be one more leg to the upside. And that's what we're getting. Now, having to do with the DXY itself, before I jump on the rest, keep in mind, yes, we're seeing one more leg higher, probably starting here. Keep in mind that 94 remains a very key area of resistance. So, all that is good and well, but, nothing really convinces me unless I see a break above 94. Okay, so yes, it looks like we might see some continuation to the upside, but, do we really have like some important low in the dollar? I'm very skeptical about it. I mean, personally, I feel quite confident that the answer is no. Now, we can extend higher, but I think it's going to be part of, like a bigger correction. Now, having to do with indices, I'm sure that Blake covered the S&P, so I'm just going to stick to the NASDAQ. If you remember, we have talked about the importance of this. NASDAQ has now slipped through this 11,000 area. So, in all honesty, I don't really see any important support until we get just below 10,500. Let's also see, out of curiosity, where do we find equality of the two legs lower? Yeah, that would point to 10,000. So 10,500 first area of support, and then 10,200 more or less. So yeah, I do think we might see a little bit more weakness, at least a little bit more weakness, because with these markets you need to be very careful. I mean, we know that all the market forces are pushing higher. We know that the government is going to want to have the index supported ahead of elections. Every government would. I mean, it's not the exception. We know that the Fed's main indicator, they will never admit it, but it's asset prices, because in all essence, with monetary policy, all they can do, the thing they can more easily affect is asset prices. So, that's where they're focused. They will never admit it, but that's what they do, and that's what where they focus. So I wouldn't be surprised if you see another couple of days of weakness. I'm pretty sure that conveniently, Fed speakers will start coming on the wires one by one, giving some hope to the markets that one way or another, there's going to be, more stimulus coming through. One more thing that hasn't helped, obviously, continue the maddening uptrend is the fact that the Fed's balance sheet has spent quite some time now consolidating at 7 trillion. Keep in mind, from a technical analysis perspective, I'm joking, of course, right? I'm not implying that you should be doing technical analysis on the Fed balance sheet chart, but half joking, I think this is just a symmetrical triangle before we explode higher. So I think that this short-term pause in expanding the balance sheet is just that, a short-term pause. And I do think that we're going to explode higher. I personally believe that it's extremely likely that we might even see 10 trillion even by the end of the year. I think that might be a little bit excessive, but within a year from today, I think it's almost a given. So keep in mind there's a lot more stimulus coming one way or the other. Dale, do we have a guest?
Yes, Daniel Hussey.
Oh, okay, so no time for questions. Okay, perfect. So more tomorrow.
Okay, Steve. Hi, Daniel. Welcome back, buddy. I'm going to get you set up. Okay.
There he is.
Hi, Daniel. Welcome back to Face.
All right. Can you hear me?
Got you, buddy.
Loud and clear.
You want to share your screen now?
Yeah, I will. Give me a second here while I get it finalized.
Okay. All righty. I've known Daniel for many years, going all the way back to FX Street, and very good technician, real clean charts, no BS on Daniel's charts. You see those lines and they mean something. So you told me you're going to be talking about grains. I think that's going to be interesting with, the fact that they're coming out of multi-year bases and starting to perform.
Yeah, they absolutely are here. All right, let's see.
What asset class did you talk about, Dale?
Grains.
Grains. Okay.
Yeah, I mean, beans led it, and then
my prediction is all of those assets are going to explode denominated in dollars.
Yeah.
Yeah, I completely agree, and that was one of the topics I talked with Dale originally about, was how, let's see, can you guys see that screen there? Got a corn chart up, I think.
Yeah.
Great. Before we even hop into corn and into the charts, though, I figured, Dale, like you said, we've known each other for some time now, back to the days when you were with FX Street, and I was with Elliott Wave Forecast back then. Wow, how our careers have changed. And, I began my career on the floor of the Mercantile Exchange, actually in the Eurodollar options pits, but, made my way into grains. I thought it would be interesting to give a little bit of my backstory here, because I think it resonates with a lot of the traders out there. Many of us began or started our careers looking at FX. It's the most easily accessible markets out there. They give you the highest leverage, and you can get the most bang for your buck in trading those markets. But you're a minnow, in the middle of the ocean, and there's this giant whale called a central bank that can come around and decide to change monetary policy overnight, and makes trading, while trends, right, in currencies can be great, long-lasting. And I really enjoyed some of your commentary, you guys, earlier today. That was great to see that. I think we have a lot of the same ideas of what might be.
Do you remember Floor Trader? Daniel, you remember a Floor Trader? His last name was Bregman.
Mm-hmm.
And he used to take on central banks in the IMM pits. And, it's before there was a lot of coordination. And, he loved to fade central bank action because he felt that, whatever they were doing before central planning really gained momentum was just temporary to support their currencies. And there were all kinds of currency devaluations in the 80s and, late 70s. And they used to call them the bank So yeah, you learned a lot on the floor. When were you on the floor? What years? I know you're a lot younger than me.
Yeah, I caught the tail end from the early 2000s there
Okay.
through actually my late high school career through college. I was on the floor during the summers, had a brief stint there out of school, and then the financial crisis happened, and I took the great advice from the broker I worked for. I was an arbitrage clerk. For those that don't know, I was one of the guys with a headset making all the funny hand signals with some of the banks that were lining the outskirts of the room, coordinating trades, and I would pass those trades to the broker, who then would turn around in the pit and fill those orders for the big banks. They gave me the great advice, Dan, you got to make sure you finish school, get off the floor, go learn how this industry happens behind the screen, because that's the future. And boy, wasn't that the truth.
Yeah, a lot of people couldn't make the transition because they made money off paper. You know, all they had to do was, trade the paper, either filling it or scalping off of it. And once that disappeared, it was career ending for a lot of people.
It really was.
Those lucky bastards.
Yeah. You know, what a time of an era where you could have a slightly different market on two sides of the pit and give those locals the ability to take it from one side, move it to the other, make their tick in the middle, and fill that paper. And you know, it was a job to be done, and they took on risks to do so. But unfortunately, right, the likes of algorithmic trading and high frequency trading have made that more efficient, you could say, and unfortunately, way too quick for the human hand to deal in.
Yeah. So we're looking at Dixie. Your background, you know, you were fortunate to catch a tail end and be able to rub elbows with guys like that on the floor. Much tougher now for people that have to wade through the internet that want to learn about the markets because there's so much junk out there.
And it's
that
funny.
You really Go ahead.
In the shower this morning thinking of talking points, and that was one that came up was, wow, why over the last 5 years did I move away from some social media and really hone in on my training? Because I thought I lost my own voice, and I felt like I was losing touch with good information. There was just so much noise out there on the internet, on Twitter, on Facebook, everywhere you turn, every news media agency out there today. It is all about hysteria, chaos, and keeping that kind of keeping that running through society. And it's been that way for, it feels like 10 years now. And with this latest pandemic, it really has come to a boiling point, hasn't it? I feel that you can get lost in that noise as a trader. And it's very difficult in many markets, which is a big reason I moved to focus and hone in on grains and kind of regrow from there, is because I came from trading currencies, which actually are not that different than grains, which we'll look at here today. Spread markets. If you can trade currencies, you can trade any spread market in the world, because every currency is a spread. You already understand the idea of two moving markets, the value of one currency versus the value of the other. And we're always trading them as spreads, right? And FX crosses. And that translates into grains very, very well. The problem we have with FX, or maybe even indices and other markets, the only problem I ever had with them was, how do I hone in on the fundamental side of the trade and really, you know, sink my teeth into what seems to always be a tough trade to get behind, which is trading fundamentals in some of those markets. They oftentimes, right, get faded for a little while. It takes longer for the true longer term fundamental to come through sometimes. And sometimes the technical trade really dictates price action, which I think is why many of us gravitate to technicals, because there's a lot less noise when you look at a chart objectively that way.
All right. Well, you're on the Merc, Daniel, and I'm getting a question because I sure remember this pit. Forex Gal is asking, sell or buy lumber, and the lumber pit had quite a reputation, didn't it?
It really did. The gold pit as well. It was an old boys club, if you will, that if you were not on the inside there, you were always going to be on the outside and never getting the best service, if you will. I don't know how else to put it. But there were always legendary stories about how, markets that were that tight knit and that closed off, particularly lumber, right? There's only so many lumber producers in the world. There's only so much supply. It's not like gold that where it's being held in every bank and vault in the world. Lumber's got a very niche market, right? And like all commodities, it really, there is an element of supply and demand. However, lumber is a small enough market where single market participants can come in and be the lion's share of volume or participation. That's very hard to do in the E-mini or the bonds. I would actually argue impossible to do.
So would you agree with me when I would tell Forex Gal, find something else to trade?
Absolutely. We live in an era where there are markets with such deep liquidity and such fast execution that there's no sense dabbling in those markets where you can get really stung just by failure of execution. You could be dead right about the trend and lose money because you fail to execute it in an illiquid market with slippage and all of these other things that can go into it.
A lot of limit moves.
Yeah, absolutely. When you wake up the next morning and there have been almost no trades and we're just at a limit move higher, that's a typical day for lumber.
So that was a good question. It's probably going to save you some money, Forex Gal. All right, so Daniel, we're looking at Dixie. I have a bias that formation we saw in August is a 3 drive to a bottom, and 94 is big, but to me it looks like we have a bear market rally setting up that could get to your horizontal box and maybe your purple line before it runs out of juice, in my opinion.
Absolutely. And the lines on the chart here, it's a simple 50, 100, and 200-day moving average, everyone. And it's the most simple, definition of a trend many technical indicators begin with. The thing I want to point out is we've had that bearish crossover for both the 50, 100, and the 200-day moving averages. That's big on a daily technical time frame. That is an indication, that, hey, maybe something is shifting on a longer time frame for the US dollar to the downside. And when you take that step back to a multi-year chart of that Dixie, you see that 104 to 90 to 89 range we've been in. And it feels a lot like the market is in a period of price discovery lower down to the low end of this range in this, kind of leg lower that we're in. I tend to agree with you. I saw a little bit there at the start of the webinar about this 93 to 94 area. Yeah, we've got a congestion zone that we've now broken below. Series of highs, or excuse me, lows as we were coming up in this, very choppy trend higher for the Dixie, are now making for, I think a cluster of resistance on the way down that we're trying to hold below. Those key levels bring us all the way back to the end of 2018, when I think we saw a pretty dynamic shift in the dollar. We saw the trade war with China kind of come to the front and center. We saw exports for the U.S. dive off. And by the way, China started talking with a rhetoric that they would love to do business with the U.S. And I'm really speaking more towards the grain side of things here, because that's where we've been able to get a deal done and move forward with some trade. They were always talking about this rhetoric of when, quote unquote, market conditions allow. And our team at Zaner, myself and another senior broker here, Ted Seifried, we kind of took that as, well, what are the things that, what are the comparative things that China would be looking at in our commodities, that they would need? Because the fact is China has 1 billion people. They need to keep fed and happy. That's true of any nation, right? But the difference with China is that over the last 20 years, we have seen them unfortunately go from a highly agrarian society to now highly urban society, and now do not produce enough agricultural products to feed their own country. So they are now economically dependent on export or on agricultural imports, particularly for soybeans, pork products. U.S. corn now is on that list as well. These are needed to keep not only financial but economic and social stability in China, because the worst thing any nation or government could have is a famine where people are not being fed. And Colombia and Argentina of the last decade are a good example of countries where when you run out of food and you can't feed a population, you see civil unrest begins very quickly. All that being said, what did that mean for the dollar?
And Daniel, aren't they having like issues with pestilence in the crops, something called an army worm.
Yes.
I'm not sure which which crop it feasts upon. Is
Corn.
it wheat? Corn?
Corn,
Okay.
in fact, it has been decimating, and China has never had a good. China, so everyone is aware, is on the exact same growing season as the United States. So to give everybody the quick rundown of supply and demand economics in grains, it's very simple. There are two main supply times during the year: when the northern hemisphere harvests corn and soybeans, and when the southern hemisphere harvests them. Other than that, we do not produce this commodity at all throughout any other point during the year. So there's only two times during the year that we adjust how much we've produced and know what the supply side of the economic balance sheet looks like. Now that demand side, that's all really contingent on China. But China also produces corn and soybeans nationally. They, however, have been very poor at producing a corn crop. They've been very poor at storing a corn crop historically. And you're right, they are plagued by other infestations of insect plagues that we do not get, like this army worm that this year decimated their corn crop. Over the last 3 weeks, we have seen now China talk about maybe upping their corn purchases from the United States. And we've not only heard rumors of going from purchasing around 7 million, around the 7, now I need to look at the actual number. But anyway, they were going to increase it by 4 times. And we've seen exports over the last 4 weeks that have kind of justified that pace of purchasing. And that's the big story, I think, in grains here, is that since August, China has come in and purchased about 50% of what they needed to get not only the phase 1 trade deal done, but to make good on all of the estimated exports for this year. That's been done in the last 8-week time frame. That's an exorbitant amount of purchasing. And while the dollar has declined, and just to bring this back to finish that
supports grain prices, the weaker
absolutely.
dollar nominally.
Bingo. Anything dollar denominated, our export markets get hurt. Doesn't matter if it's oil, doesn't matter if it's corn and beans and other agricultural products. When the dollar goes down in value, outside forces, those exporters actually have more purchasing power. And that idea of soybean prices going higher actually helps China in another way we'll look at later. But the fall in the dollar, we believe, was the exact rhetoric or meeting of the rhetoric that China needed, the quote unquote market conditions, to start with these purchases. And if we go back to 2018 to 2017 and this last big dollar decline, well, that marked the last record for Chinese exports of soy products. Then through 18 through 19, we got into a trade war that brought us into 2020 and sent the dollar to its highest levels in a decade. China ultimately seized up on their purchasing and did nothing. All of a sudden, starting in June of this year, we started to see big purchases start to come out of China. And along that same time frame, you'd think that that would be positive for the US dollar because, right, China's using US dollars to buy US goods. But there's some other forces going on behind the scenes in bond markets, with treasuries, and just the currencies that are keeping the dollar down. And China used this opportunity over the last several months to do major one-off purchases of US agricultural products to make good on both their phase 1 trade deal and take advantage of the market conditions that are beneficial for the Chinese trader.
They're pretty good technicians too, right, Daniel?
Yes.
So if they see what we see and that the dollar could come back 5% or
absolutely.
so, this is the time to do it with the cheap dollar.
And that's what we're seeing, I think, a lot of today. These rampant exports of agricultural products over the last 4 weeks are a response to this. And that's why, as an ag trader, I'm following currencies every day because these matter. We get a move up to 95, 97 in the Dixie. That could slow down China for a bit. And I would know as a grain trader, maybe these markets that have had such a strong run up are also going to see a little bit of a setback. Take the price of November soybeans. We've had a run up from the 808 level. The lowest prices for Novi beans. Actually, let me bring up just the daily chart. We don't need a continuous chart up here for this. There we go. Contract low is at 830 here back in on April 20th. we have rallied over $2 since that April 20th low. And really the August 10th low that marked a major USDA announcement where the USDA came out and basically said that big storm we had in August, plus a lot of the dry weather we had to start the month, the USDA came out and said, yeah, we are not going to make yields where we thought they were. Coupled with Chinese purchasing, you can see the very, very perfect storm that occurred in soybeans for a rally, which was you've got your biggest buyer in the world coming back to the US market and buying hand over fist everything they can get hands on. You had a USDA fundamental report that came out and said, hey, yields are not going to be the best we've ever seen, which is what we were all anticipating at that point. And they reversed and walked back and said that storm and the drought over the last 4 weeks has done enough damage that we have made our crop. So ergo, all the traders, including myself, get the mentality that, okay, we can't do any better on yield. So whatever we've produced is in the field now. It can only go down from here. And thus price rationing began.
It looks like the silver move.
Yes. And it was an explosive move that, you know, was there something here holding prices down for some time? You know, I'd like to, you know, put my tinfoil hat on and say that maybe China was very short soybeans in the US on the board and then decided to get very long soybeans on the board, because if they're going to, you know, continue with future purchases, they can only get their hands on so much physical right now. They've got to go to the board for the rest of the future purchases for the rest of this marketing year. So seeing the run up now to 10, up to levels of near 1040, the real question is how high can this market go? We're at uncharted territory for the November soybean. These are new contract highs. We are well above the highs we were holding below 2018 through 2019, which was this $9.80 to $10 level. And that's right where I would put, you know, our current broken resistance, now support, going into the end of the life, you know, end of the contract and into harvest. If I could get a rectangle to draw for me. There we go. $10 is a key psychological level for soybeans. But we do have now the 50-day moving above the 200-day. The 100-day is starting to move maybe above the 200-day here over the next couple of days or so. So we're getting that golden crossover event as well. This, to me, now when you step back to that larger time frame, look at the continuous chart, look at where we were in 2018, right? Back when the US dollar was at its lowest levels in the last, you know, few years. We were up at 1050, 1060 in soybeans. We've traded right back to those levels in soybeans here today. And I am of the camp that I think we're into this $10.50 to $11 range in beans as that US dollar makes its way down towards that low 90, you know, dollar area in the Dixie. So you're seeing some correlation here. While the soybeans took some time to really catch up on that trend, they are coming back to the levels where I think there is some correlation between when and how China's participating in a market. We're seeing them buy every day with new flash export sales. Those numbers usually come out right around now. Let's see if they had a new purchase today. They did. It looks like China today just bought 132,000 metric tons of soybeans. That 132,000 metric tons equates to, I'll tell you how many bushels here in 1 second. For those that you follow along, the U.S. counts everything in bushels, while so that's about 5 million bushels worth of soybeans. The USDA, to put that everybody into perspective, that is 1/20th of what the USDA thinks we will have left over for soybeans at the end of the year. And that's a very substantial thing because, hey, soybeans,
no carryover.
Exactly. We only produce soybeans but once a year in the United States. So at harvest, we'll have all the soybeans we'll have again until next November. If China just bought 5 million bushels worth, and we think we're going to only have 400 million bushels worth at the end of the year anyway, China only has the rest of this month worth of exports. And they've been doing this every day, buying at least 5 million bushels for the last 2 months. If they keep at this pace, we will literally run out of beans before harvest is complete. And that is what the market's starting to realize, and why we're seeing this massive, what is referred to as an inversion, a big run up in the front month prices of soybeans, because people are afraid we won't have them down the road. And when you look,
it's the opposite of backwardation, isn't it?
Correct. It's the opposite of backwardation. And when I'll open change these columns here so we can all see the, here we go. You can see the November soybean trading at 1039, right? Well, if we go back to July and November of next year, July soybeans of next year at 1029. They're below. You can buy soybeans July of next year cheaper than you can buy them right now. And that's not typical in the grains, but the reason being is backwardization, like you just said, Dale. And it's because there's a fear that we won't have them in the future, so you need to get them all right now for whatever.
As opposed to carrying charge market.
Correct, which is where you would be.
Prices would be higher in the deferred months.
Correct, with the idea that you are recouping some of the storage costs to get yourself to that month. And that's what happens in more bearish market conditions. And over the last 5 years, that's what we've seen in soybeans. We've seen conditions where we've produced absolutely impressive record yields. This year's soybean yields themselves, the USDA was originally thinking, this is a chart from agmanager.info. This is the K-State Ag Department. They do a great job. Anyone that wants to pull the very quick economics and get the data on grains, because it is so widely known, this educational institution publishes them all after every major WISE report, so everybody can go and get them. I use them. Everyone I know goes and grabs these because they've done the balance sheet for you. In other words, what does it look like, that supply and demand economic? And you can see how this year we thought that trend yield, which is what we anticipate how much yield increases every year because we get better at growing. We anticipated us being better than trend yield this year. Now that's not looking like the case because we're going to be backing off that trend yield, and U.S. exports of soybeans have been just absolutely astronomical. And while this continues to grow, those soybean potential, our export potential continues to grow, our ending stock continues to diminish. And you can see here, this was as of our last report. We were thinking we'd have about a 10% stock to usage ratio. That means that that we would have 10% left over at the end of the year of what we would need for the following year. In other words, we'd only have 10% of what we needed for the entire year's demand left over. Typically, and this is a good ratio to use in grains because it's very straightforward, and it really only changes but once a year at harvest, because you know how much you produced, how much you have left over, and how much next year's production may or may not be based off a trend yield. You can kind of figure out more or less if prices can be more bearish or bullish. Because we're going into what we refer to as a tightening event, we're seeing supplies really tighten because China's exporting them, they're taking them away. This ending stocks number and the stock to usage ratio is shrinking. And when we dip below this 10% threshold, we start to see, the elasticity of demand really starts to show its head. In other words, we really start to run out of beans and people become fearful. 2012, back in 2012, we had a major drought. That's what sent soybeans up $15 to $18 a bushel. I don't think we'll get that crazy, but you can see how below $10 or this 10% threshold is really, if you go back and you look at any of these years below that threshold, you will see that those are the years where, okay, there's clearly more of a bid under grains. Markets are more well supported because we're fearful that there isn't enough demand or supply to meet that demand. And running out of foodstuffs is one of the more scary things that can happen in commodities, and hence why people, there is panic buying that can occur. And that's what I think we're starting to see. That's the trend we've been seeing, and it's all really, really been kicked off by the value of the dollar and those market conditions that China needed to see, which is all, in my opinion, completely tied to the value of that US dollar.
What a great presentation, Daniel.
Awesome. Well, I hope everyone enjoyed it. For some upside targets here in the near term.
Beans in the teens, bro.
Yeah, we could. If there was a year and an opportunity to see it happen, it could. Obviously, when you look at this continuation chart, you can see going back to 2016, 2017, there's some congestion zones here, $12, $10.50, $11 to chew through. But if there was ever a year to do it, this could be it.
And the best way for people to follow your work besides Twitter, or including Twitter, Daniel?
Right. You can find me on Twitter at Daniel Hussey Jr. You can also shoot me an email, dhussey@zaner.com. 312-277-0110. Drop me a call if you ever want to talk commodities, risk management, and particularly in the grains. But following me there on Twitter would be the best.
How
way to
about,
find
can
me.
I call you to talk about the Bears starting 2-0?
Absolutely. And how about Travinsky finding his arm, huh? I'll take it.
You found your voice and he found his arm, and thank you for really edifying our community and talking about, you can't eat gold, can you, Daniel? So
no, you can't. You can't.
And they call beans protein gold.
That's right. That's right.
It's still
are.
like buying gold, only it's edible.
And in a year where we might be seeing some higher inflationary type pressures, agricultural markets will benefit from those as well.
Thank you for edifying our community today, my trading warrior brother. Appreciate it.
Absolutely. Have a good one, Dale, and take care. Have a good one, everybody.
All right.
Bye.
Daniel Hussey, follow him at Daniel Hussey on Twitter, and he's with, I believe it's Zaner. It's a commodity. I'm not sure if it's an FCM, IB, but I know the name.
We are an IB, yeah. If I'm still on with it, we are an IB, and it is Zaner Financial Services. But thanks, everybody, and now get off here.
All right, I'll get, we'll hook something up for down the road, Daniel. Thank you, buddy. So that's a wrap, everyone, and we'll see everyone for Turnaround Tuesday. Good hunting. Remember to sign up for the summit and our offer. I'll see everyone tomorrow. You're welcome, Skip. There you go. That's where you can reach Daniel. You're welcome, Brock. Thank you, guys. See you tomorrow for Turnaround Tuesday. You're welcome, Sa.